environment. And we are joined today by Kezia Samuel, who is the Chief Market Strategist for AssetMark. So, Kezia, I know that you have a lot more to yourself than just that title. I don't know if there's anything else that you would like to share with the group, but we're really excited to have you join us today as we address the current state of the economic climate and the markets.
Thank you for the warm welcome. And I think my title, has gone to try and just make sense of what's happening on a daily basis. So hopefully we'll bring clarity to what we know today, rather than trying to forecast the future. Lindsey and I were having this conversation, nearly impossible to do in such a fast-paced environment, but instead the objective is going to be to provide clarity in the present. So I am going to share my screen and see if this functions well. Let me make this larger as well. Lindsey, just making sure that I am sharing the screen and you're able to see if I could get a verbal yes.
Yes, everything looks great.
Fantastic. Let's start with today's discussion is going to focus quite a bit on tariffs, but our conversation is going to follow into three buckets over the next 25 minutes or so. One is just a quick look at the markets. How have they behaved through past Friday's close? Then we'll talk about the economy with, again, tariffs, the impact on the economy, DOGE cuts. What does all this mean? We'll try and decode that as much as we can. And then ideas on how we're investing in this very unusual environment. So that's sort of the segment in how we will break our conversation up today. Let me start with a review on how markets have behaved so far on a year-to-date basis and some longer-term perspectives as well across a variety of different investments through, again, last Friday's close. So the first thing I want to do is take your eye to the left-hand side where the table has a variety of different indices. And to give you a snapshot on the year-to-date basis, the summation is much of the pain point has been in the US stock markets, which started this year priced for perfection relative to its international peers. And so that's where we've seen the majority of the pain point. You can see the US stocks as represented by S&P 500 is down 8.5%. In comparison, international stocks, which have given away much of the gains since the tariffs went into effect, but nonetheless positive. We're also seeing bonds hanging in there, despite interest rates starting to also show some cracks in there, but bonds are also working. And then gold and the broad commodity complex, as a result of potential for higher inflation, economic uncertainty, are also working this year. That takes us to the global 60-40, which is our proxy or a benchmark for a diversified client with moderate risk tolerance. And you can see in comparison to the stock market volatility, yes, it has seen some losses on a year-to-date basis, but far less. And this idea that diversification is working is still hanging in there. So outside of US stocks, international stocks are up, bonds are up, commodities, and also gold being up, helping that moderate risk client stay intact. You'll also notice I want to point out one more thing on that table on the left-hand side. Take a look at the globally diversified 60-40 portfolio. So these are stocks across the globe and the bonds on a one-year basis is now outperforming both stocks in the US as well as international. And this is, again, that paradigm that after 2 years of 20+% returns in the S&P 500, where we were quite exuberant with markets and the US came out on the top consistently over the last 15 years, that no trend persists into perpetuity. And here's a reminder that balance in the midst of uncertainty is likely a course that we'll rely on even through the ideas section. But much of the pain, so I want to talk one more thing before I move on to the economy. Look at the right-hand side. In the US equity markets, we've had a phenomenon where the technology stocks, these stocks called the Magnificent Seven, you've likely heard of them, all tied to artificial intelligence. So the likes of Apple's and Amazon's and Nvidia's were really the drivers of returns over the last 2 years. But as the tide has shifted, those stocks truly were priced for perfection, and some of these tariffs take a bigger bite, given that these companies have more than 50% of their earnings exposed to abroad or other markets, has taken, you could see, down 17.5% in comparison to the remainder 493 stocks. Yes, they're down, but not to the same extent. Again, the style of stocks you owned have also mattered in this year. So net diversification is continuing to serve its purpose, perhaps not the way we had imagined, but it's been a hard year, certainly for US stocks, specifically for technology stocks. Let me continue on. So that's sort of a quick snapshot, helping us understand what's on our statements. But again, investing is all about the future. So I want to pivot into the economy. And I'm going to start with, let's take a step back from tariffs and look at all of the policies for the current administration and see if we can make sense of where it lies as it relates to its impact to the economy as well as inflation. So you'll notice here we've done a very simple chart. If it's a green arrow, it's helping either growth or inflation in the right direction, meaning good for it. And if it's in the red arrow, meaning it's hurting it and or detracting from it. So a few things here. First, you'll see that if I look at this holistically and took a step back, the number of green arrows when it adds up more should tell us that it should be pro-growth policies and or pro-inflation policies. As a sum across trade, immigration, fiscal, tax, as well as regulation, it should be a relatively pro-growth and relatively also higher inflation. So kind of taking an impact from both sides. But what we're seeing is that the sequencing of the policies that have come in play have been all on the negative end. Both trade, immigration, as well as the fiscal DOGE cuts are all pulling back from growth and also hurting inflation at the same time, causing this initial stagflationary impact at the cost of entirely leaving out some of the pro-growth policies on be it tax cuts and or deregulation that's coming out at the end. I don't know about you. I tried to think of, the President Trump talked about these policies being a sort of a medicine that the country needed. And I think in the simplest way, if you've seen Mary Poppins, there's a line that says, a spoonful of sugar makes the medicine go down. Sadly, we've gotten just the multiple spoonfuls of medicine with no sugar, which is coming in the second half of this year. So the policy sequencing has also created this ramped up uncertainty. But we do think that as we get through these tariffs, big cloud of uncertainty, we likely are sitting on possibly pro-growth policies that are just not getting the attention. So we're kind of trying to have a holistic view. But having said that, let's dive into tariffs because there is no escaping it. It's on, it's off, it's certainly hard to keep track of. I was telling Lindsey as I was having this conversation behind the scenes, I stopped writing in the mornings because by the time the end of the day would happen, something would entirely derail my entire thought piece and I would have to restart my thought content. And so you could see that it's certainly disruptive, not only as a person who follows this on a daily pulse, but I could imagine from the end consumer, it seems very chaotic. So what I want to look at this chart here. You could see what we have in effect today, what has been on hold, and then what's been modified. So we currently still have a 10% baseline tariff that went into effect April 5th. There is an exemption for electronic and tech things that just went into effect today. Reciprocal tariffs on hold. You also have China currently at 125% question mark, possibly 145%. Again, exemptions to technology just in play today, also in effect there. Canada and Mexico somehow came through this actually a little bit unscathed. Only non-compliant goods under the USMCA are being tariffed at 25%. There's also a 10% for energy, but I can't squeeze it into the page, so hence the limited space there. And then last but not least, we've got auto tariffs as well as steel and aluminum tariffs. But if you look on the right-hand side, just globally to create a visual impact, if you take all of these tariffs, there's really no place to hide, which is why the volatility in the marketplace has been so strong in that how these tariffs have been approached, they're quite widespread. And this is one of the reasons why the markets are trying to digest. But another key thing is, it's also told us that initially we expected the tariffs to be quite rigid, that there was no room for negotiation. And we're starting to see that's not the case. 13 hours after reciprocal tariffs went into effect, they went on a hold for 90 days. Same thing with the 145% or 125% on China going into effect. Immediately following, one day later, we're seeing these exemptions take place on technology, which is top 5 in the exports from China. Regardless, if I take all of these tariffs into play, what we find is that the effective tariff rate, take your eye to the far right-hand side, went from 2.2%, which is where we started the year, all the way possibly currently ranging from, and it's very hard to put this because we don't have a full scope, ranging somewhere north of 15%. And you can see if that is where we end, this current effective tax rate is higher than the 1930s Smoot-Hawley effect. But the big question remains, which of these tariffs are going to be here and to what extent? And we're going to talk about the objectives of what some of these tariffs are being used for, which will provide us some clarity on which ones remain and which ones don't. But as it looks at how do you make sense of this? So one of the things that we've been trying to do is trying to understand or decode the impact of these tariffs to not just the US economy, but to the global economies. So one way of simplifying this is to see which countries have a greater reliance on export, and those countries are likely going to have a greater hit to their economy. So one salve in all of this is that the US economy is less reliant on export. As you can see here, only 11% of our economic output is reliant on exports. And that's been known. That's probably one of the objectives that the administration is trying to resolve in trying to get some of the manufacturing onshore. You can see similarly, both Germany, Canada, and Mexico have a greater reliance on exports. And so they're likely to have some negotiations as part of the overall tariff. If the objective is not just to mitigate these trade imbalances, but also to pay for some of the tax cuts that are likely in play as part of the budget's bill that's being orchestrated in the blueprint, then those tariffs are likely to remain longer. If it is simply to get a better trade deal, then we think those are going to be temporary in stance. So our likely base case is not the current effective tax rate at the max where it sits, but somewhere in between as a way to fund some of the future tax cuts that they want, plus to bring back some of the manufacturing, bringing back the total effective tax rate to less than where it is, given the impact to other economies are likely to be just as harsh as it is to the US. Add to this the fact that we've got DOGE cuts taking place. So we haven't talked about that in the same extent. Here we wanted to give you a baseline of where the US economy stood in 2024. And you can see we had 2.8% economic growth, which for a $30 trillion sized economy is fairly good. What we've done is highlighted what actually contributed positively, while what those that detracted. And you can see trade and inventories detracted even in 2024, and that's likely to be a hindrance even in 2025. So those two likely to be negative, but probably a greater negative. Add to that, the government spending is also going to be pulled back. So while it was a positive in 2024 of 0.5% to the US economy, it likely is going to be, if not small to flat, We don't see an outright negative in the near term, given some of the Doge numbers haven't quite lived up to the original estimates. But nonetheless, you can see the impact of that is showing up fairly quickly in the US economy. And what you're seeing here is the Atlanta Fed. It consolidates all of the data and it tells you where the US economy. So it's not a forecast, but it's simply saying as the data comes in, where is US economic growth going to lie? And in the first quarter, it went from forecast looking at a 2.4% positive economic growth, look at the light blue line, to it looks like a wall straight down. And that was driven partly because of how companies are adapting. Look at the dark blue line now. In advance of the tariffs kicking in, companies went and preloaded or front-loaded some of these goods in advance to try and avoid themselves getting caught in the tariff, back and forth. And as a result, our imports exploded well ahead of our exports, causing our trade imbalance to go in the opposite direction. Why? As companies were trying to adapt. So this caused the US economic growth to truly pull back. But we also had something very interesting, which was gold, which had a bit of a disconnect in prices. Gold's prices in New York were much higher than gold prices in London. And as a result, we saw companies and banks, as well as institutions, flying gold bars across even commercial planes. But that is not necessarily included in the actual economic GDP. You exclude that, and there's this dotted gold line. We expect the first quarter economic growth to be flat to slightly negative, right? So excluding this gold number from that total trade deficit that we're going to see. But nonetheless, you can see we expect the US economy to slow. Now, is it enough to cause a recession? Now, it's very hard at this point to see the current data telling us that we're in a recession because the starting point of the US economy was very strong. How do I see that? Take a look on the left-hand side. This looks at household net worth, which started the year at very high levels, not just for the top 25% of the US consumer, but also for the median. Why? Because we started the year with strong portfolio values, but also strong household price. And so total net worth, which looks at your portfolios, your home prices, home equity, plus everyone is essentially still employed. So that started at a good position. Now, despite the stock markets dropping, you could see from the earlier point, it's not necessarily a broad spread because the international holdings are still positive. So yes, it may have come back from the top peaks, but the household is still hanging in there. Add to that, you can see on the right-hand side, the job market is still relatively stable. It is certainly slowing. We're starting to see unemployment claims rising, but we're not seeing widespread layoffs. So the US economy was in a relatively good standing. The way I described it was, it's like jumping out of a basement window. It doesn't hurt that much. It can take some policy shocks, but it cannot take unlimited policy shocks as we have seen from this ever-changing tariff narrative. So we have the probability, we're at a 50-50 at a potential recession, but it is not necessarily that we've seen a foregone conclusion. One of the things that we're watching for, what are we looking for as this data changes, has been the consumer. The US consumer is the engine of the US economy. 75%, as I showed you earlier in that report card for the 2024's US economy, is driven by us. I call this my Friday night visits to either Target or Costco, depending on my mood, to continue supporting the US economy. And you can see the consumer is starting to feel quite sour, but their behavior hasn't quite modified in the actual data. How do I see this? One simple example. When asked of the consumer, do you plan on taking a vacation? Take a look on the left-hand side. You'll see they've kind of said, no, we don't want to take a vacation. And I use the vacation as the ultimate discretionary spend. You still have to buy, your household basic goods, but vacation is a discretionary spend. You don't have to do this. And so if they're starting to pull back on that, it sort of is a preview of their spending habits down the road. But when I actually look at the hard data of what is happening in the TSA traffic, you'll notice it's sort of stood stable. Yes, it's slowing, but it hasn't necessarily immediately shown up in the data. So far, I think it's if tariffs are used as a negotiation, then there's likely to be limited damage. But if it's not and the current state remains, then it's likely to be a higher probability of a recession. Same thing with inflation. Tariffs are a form of tax and they lead to higher inflation. And however, the data that we have so far, you can see even the latest one, is not indicating that. We just got an inflation reading last week and it was at 2.4%. And it's showing us that the progress that was being made was heading in the right direction. It is still well above the Fed's 2% target, but this tells me that tariffs impact has not shown up in the actual inflation data. So we need to watch this fairly closely. And the last thing I'll mention here is the following. In the midst of this chaos, how do we keep track of, and what are we keeping track of? We're watching the bond markets very closely. If there's one component of the financial market that has the ability to check administrations, not just current, but past policies that may not be aligned with a structural integrity of the financial markets, then the bond markets is that component. What do I mean by this? Let's start on the right-hand side here. This is the 10-year Treasury. And when the yield, we've kind of highlighted in simple terms, just what has been happening to it. Before the elections, we saw the 10-year Treasury yield sort of rise, and you can see right from that October time period, it went all the way to 4.8% because the economy was good. Add tariffs on top of that, as the markets were expecting, and the inflation concern was the primary concern. But since then, 10-year Treasury yields have retreated, and now most recently it has come back up again. As you see it oscillate between the two, what is it telling us? It is telling us the following, that perhaps the policies that have been put in place are likely to be deficits continuing to rise, but also pro-inflation. And so the markets are demanding a higher interest rate despite recessionary concerns. That's what this tells me. And if interest rates rise, which is not in the Fed's control, the 10-year Treasury is driven by market participants, not the Fed's control, it tells us that the cost to fund our future deficits and to run the economy is going to cost more. So it's going to cost the government more. And it's also going to cost the consumer more because the mortgage rates are pegged off the 10-year Treasury. So this is an important indicator that we're watching very closely. And notice the minute the 10-year Treasury started to show some cracks is precisely when we saw the reciprocal tariffs go on pause. So again, for us, this is available widely. We're watching this very closely. But does the market tell us that we're seeing a 2008-like environment? Not quite. Look on the left-hand side now. You'll see policy uncertainty, which again, we've got an index for everything, has skyrocketed. That's a light blue line. But the cost for companies to borrow against each other, that's what that spread index is. It's how much are each companies charging each other? And you see it has risen, but it is far below what 2020 or even 2008 levels are. So bond markets are showing us that this possibly could be the check on some unsustainable policies, but it is certainly not showing us cracks like 2008 either. Pull it all together. We have to acknowledge that in simple terms, in this dial here, looking at red being bad, gray being neutral, and green being good, we've pulled back our outlook on growth. We started the year as fairly positive, and since then, we have to acknowledge so much uncertainty doesn't bode well for not only companies, but overall economy, but it's not quite in the recession territory. Again, the economy started in such a strong point. The question is, how long do these policies stay in impact and to what extent? Same thing with inflation. We've pulled it back. But again, on tariffs, on inflation, it's unlikely to be a permanent reset. Companies will adapt. But so far, it's certainly injected lower growth and higher inflation potential. I'll end with just a few ideas on how we're positioning for portfolios. The very first one is we started this year as investors likely overweight the US. And if that were the case, then you are overweight the higher, faster growing growth companies like the technology AI driven Magnificent Seven that I alluded to earlier. When you started there, that's caused, and as the markets have reset themselves, we have seen, look on the right-hand side, companies in the US have pulled back their potential for earnings, and at the same time, international companies have benefited on the contra side of things. And so what we're asking for from an equity perspective is for much more balance. It is impossible to predict when to exit and enter the markets, but that doesn't mean that as investors we do nothing. Part of the allocation is to build defense within the portfolios and find parts of the equity markets that weren't as expensive as the US stock markets. And you can see on the left-hand side, even after the pullback, US stocks are relatively more expensive than its international peers. And so creating some balance around this is certainly behooves us to navigate this uncertainty. When I look at bonds, on the other hand, I mentioned bond markets over the last week started to show some cracks, but nonetheless, bonds are offering reasonable yields as its starting point. And you can see on the left-hand side, if you just invested in the S&P 500 equivalent for bonds using the aggregate index, you get something like 4.6% in yield. And if interest rates were to drop, then you could see your bond prices appreciate as your bonds are more valuable. But on the contra side, if inflation becomes a temporary hit as a result of tariffs and interest rates were to, go in the opposite direction, your bond prices could fall. But notice the pain felt by bonds is asymmetrical at this point, given we have reasonable starting higher yields and we're no longer at zero. And on the right-hand side, what kind of bonds should we own? In an environment where we're sort of doing this tug of war, which of the beasts between growth worries or inflation worries is going to win out? For us, it makes sense. What we've done is looked at the yield of bonds of a variety of different kinds and the risk that you have to take, even in bonds. And you'll notice we put a golden dot. That's the aggregate index right in the center. But if you move your eye to the left, if you shorten up your bond duration, meaning you don't have to necessarily sit in cash, but between somewhere short to intermediate term bonds are likely providing similar yield without necessarily taking on additional risk. And the last series is, we came from a year after two consecutive 20+% returns in the S&P 500. And we saw the maximum drawdown over the last year was 8%. We didn't even get, as this chart shows, intra-year corrections of on average 14% are quite normal. And it doesn't mean that the markets end in the negative. This is despite intra-year corrections on average of 14%, the S&P ends positively. Now, I'm not sure where we end this particular year, but trying to time the markets by entirely exiting in and out is very, very challenging. As we saw last week, one of the best days in the markets happens in the cluster of all the bad days. And so to try and avoid just the bad days also comes at the cost of missing out the good days. And so as an investor, balance is going to be critical as part of your long-term equity play. So we'll end with just three key takeaways. On the overall economy, we acknowledge all this policy uncertainty certainly has added to us pulling back our growth outlook. We don't think we're in a recession yet. The probability, though, has risen. And it all depends on what is the objective of how long and what kind of tariffs remain in play over the next few months. So watching it very closely. On inflation, yes, tariffs are a form of one-time inflation hit, but companies will adapt. And so again, there may be fewer interest rate cuts as a result, just given the Fed has to manage both inflation and the job market simultaneously. We need to see which of these plays out. From an investment perspective, part of the course of your long-term plans, building with Lindsey and others in the firm, it's built for the good, it's built for the bad, and it's built for the ugly. And what we have seen so far this year is within, sadly, the norm of how equity markets function. And so balancing it how you're invested matters way more than trying to just simply time in or out of the markets. And then last thing, on fixed income, bonds are providing ballast. You can pull back how far your bonds are positioned as a way to avoid some of the interest rate sensitivity that may exist in this inflation paradigm that we're still working our way through. And then last but not least, there are ways to mitigate for volatility outside of just being within stocks and bonds by adding things like alternatives within the portfolio. Okay, I've talked for perhaps far more than my allotted time. So let me go through all the fine point disclosures, stop sharing. And Lindsey, hopefully I've made sense trying to bring it all together. If not, happy to clarify anything that may not be clear either.
Well, thank you, Kezia. Appreciate all the comments that you made. And one of the things that you and I were talking about as we were preparing is this sort of human nature where we feel compelled to take action. And so one of the things I think clients have a hard time always tracking is that when we are working with a firm like AssetMark or other portfolio managers, that there is sort of proactive things that are happening on the backside that aren't necessarily always visible to the end client. So maybe you could talk a little bit about some of the points that you made as far as there's places to go within different asset classes even with this tariff situation, that clients maybe might not be fully seeing as opposed to that in and out of the market. So for example, if I'm in that 60/40 overall allocation, managers making changes within that to be sort of in areas where they might be better protected or opportunities might exist in this tariff space.
Indeed. So you're completely right. You and I were talking about the instinct is for us to do something without taking a look at the secondary impact, which is the managers you have entrusted within your portfolios have already taken action on your behalf. Let me give you two simple examples. I'm making broad-based comments here, so each individual scenario is going to vary. But we have seen one of the biggest things has been a readjustment within the US equity markets to the more defensive stance. Things like, I'm hoping all of us will continue taking showers, right? So those types of products, toilet paper, again, a staple, much more of those defensive classes. And those companies, Lindsey, were just not loved over the last few years, as I showed you in the earlier segment, where much of the attention had gone to those technology or AI-driven companies. And so a reorienting within the US markets, be it to dividend payers and or defensive companies. And that has certainly provided some ballast within the portfolios. The second is international markets. Now, international markets have benefited not just from being cheaper, right? The analogy I always describe is if you ever go into a shopping or store, notice that the stale items are never in the front. They're always in the back. You got to go all the way through all the shiny objects towards the sale rack in the back. And that's where international markets were. And many of our strategists had already started to reposition given the deep discount those companies offered. But there's something that may be not understood. International markets are different than the US markets. They tend to have much more stable, long-standing businesses that aren't very technology heavy. And so those companies, as an example, Germany, as part of its restructuring, is spending more on defense. Europe as a whole is spending more on defense. And so those companies have benefited greatly, and our portfolio managers have added to those areas that regardless of what is happening with tariffs, the region as a whole is going to need to spend more to protect themselves, given the US has sort of taken a different political stance. So those are examples of what I'm calling as almost tariff insulated. No one is escapes it entirely, but there are segments that will benefit, given that it's hard to stop spending on basics, as in the US examples I gave you, and or defense, as in the examples in the case of Europe. So that's how they're positioning within equities. And within fixed income, they've done the same thing. In the past, we'd have to lean into lower quality or junk bonds to get that reasonable 5 or 6% in yield. We don't need to do that anymore. We can come into higher quality, shorter term bonds that are still paying 5.5% as a way to mitigate some of the interest rate uncertainty as well. So those changes are happening on your behalf. Same thing with adding gold. Gold, as I mentioned, you saw, was one of the best performing. And if where feasible, in the midst of uncertainty, adding a portion to that are also ways, again, of diversifying while staying balanced, rather than trying to guess when the market is going to bottom, let alone when the tops are going to be.
So some of the questions that were coming in around international, for instance, or commodities, is the question is it too late? Have we missed the moment to sort of shift back to that? And for many of our clients, they may not know whether or not they've already had some shift to that exposure, but could you just to kind of carry on that thought to say, is it too late to be adding some diversification at this point?
So two things. One, there's a 15-year underperformance in international markets. It's hard to, just because they have outperformed by 8.5% roughly year to date, I don't think that the gap's been closed. So that's part one. No is the simple answer. But something else has happened. The dollar has fallen on a year-to-date basis. Is it because people are saying the US, as the dollar being the reserve currency, is that the driver of it? Not quite. Just like US stocks started the year priced for perfection, the US dollar has been on a tear for the last decade, priced at the highest premiums relative to its peers. So what we're seeing is a reset from the premiums that were being demanded in our currency waning. Not necessarily the dollar not being the reserve currency, because I don't know what it's going to be replaced with. There is no obvious answer, but to sum it all up on international, 15 years of underperformance is not necessarily something that we can address in a week's time period. Year to date, the outperformance has been 8.5%. It is still offering reasonable valuations. They're still cheaper than the US, so that exists. And the third, this dollar declining has also created a tailwind for international investments. Finally, unlike years past, where the dollar was so strong, even though international markets did well, by the time you brought it back to US dollar currency, you lost some of that oomph to it. So you kind of have a two-headed tailwind that was not available previously.
We also talked a little bit about this idea of, the how quickly some of these things impacted the market, how that psychologically hits us harder, right? It feels like it's happening really fast, combined with this shift of, well, now we're pausing, or now we're kind of making it be what was true this morning is not true this afternoon, as you said at the beginning of the call. So as an investor, who's listening to the news, who's trying to keep track of what's going on, we talked about some of the challenges that, you're having from a day-to-day basis. How would you recommend that investors kind of process or take in the information that's available to them in an ever-changing environment?
Yeah, so a couple of things in here. So one, I don't know if it's feasible. We also talked about what I do at the end of the day. I've got to go back to the basics of taking walks. and looking at nature as a way to keep sane. And if possible, for an everyday consumer, given the rapid nature of how things are changing, and also, not having full clarity around all the different pieces, it's really, really hard. So I'd say, one, there are three things that we're doing. As an equity investor, your average time frame should be 7 years at least. So that's one full market cycle, right? Part of this is you're going to have to look past today's noise in order to benefit from that equity investment time frame that is required. And that's why do I say 7 years? That's one full market cycle from boom to bust. Kind of has the cycle up and down. So stock markets are not something we invest for tomorrow. It's meant to be for a much longer time period. And likely all of us have that. And who knows where the markets are going to be tomorrow. But I do know, my point number two, rely on the companies that are owned in your portfolio have been vetted out for a reason. The reason that strategists that own those stocks haven't changed. Those CEOs are sitting around the boardroom and figuring out, how do I adapt in this environment? And they have come through challenges, not just what we have seen in the present day, but some way harder. 2008 was much, much harder, where it was hard to figure out what happened when the financial structure imploded. And so I think, yes, this is not to mitigate or minimize that today's challenges, feel very, very unknown because we don't know where we're headed with this. But this is not the first time that the companies that are in your portfolio have navigated a challenge like this, and have faith that they are sitting there figuring out exactly what they need to do for the near term, the intermediate term, and the long term, and will adapt. I'll give you an example to bring this home. It's in 2018, when tariffs 1.0 were taken into place, many companies adapted their supply chain from China to other parts of Asia and to Canada and Mexico. Maybe some of those will come back to the US. I don't think we're going to become a manufacturing renaissance, creating cheap toys, but on higher margin things, there's a possibility. We saw NVIDIA announce today that part of their AI manufacturing, beyond some of the factories that were already in play in Arizona, are going to be part of their longer-term plan to try and reduce some of the supply chain friction. Trust in the companies that you've invested in. Politics aside, they have done this before, and likely it's a new playbook, but will adapt. And I have much more faith in that than trying to figure out what some politician and or the current administration's plans are. Those are the two things. One, note that how we invest in the midst of uncertainty to try and pull it all together is very challenging. We acknowledge that, but rely on the companies that have stayed through 2020. We didn't know what was happening. 2008, which was a global devastation, and companies that have been through that will likely fare through this uncertainty equally in just a different format. I don't know what that end picture looks like. So hopefully, I don't know if it's a consolation answer, but that's what we're looking at. We're relying on who do we own and how are they positioned, and can they come through this in a better light?
Thank you for your comments. It's something we come back to a lot is that it feels different this time. And that is true each and every one of the times that we go through. Like you gave the example of 2020, felt different that time. Go through, it's a part of the market cycles is some of the challenges that are not necessarily always foreseen, but when we live through them, we're able to adjust and come back even stronger sometimes, as you showed from the market declines piece. Other questions that people have, which I know is sort of always challenging to do, is this concerns about inflation, interest rates. Any additional comments that you would like to make on that topic?
So on inflation, what's interesting is that the market's expectations of inflation is very different than consumers' expectation of inflation. I'll give you an example. Last Friday, we had the University of Michigan, which is a survey-based response, asked a host of people, what do you think inflation is going to be? And the consumers response is it's going to be, terrible. And ask Democrats, worse, Republicans are also starting to change their tune on inflation, so they kind of do a politically based answer. So consumers are thinking inflation is going to be really bad in the short term. In the long term, they have raised their expectation, but not to the same extent. But when I look at inflation swaps, so bear with me, I'm going to get a little technical. This is how companies hedge out inflation risks within their portfolios. That instrument has actually gone down. Why would that be the case? Why are inflation priced instruments actually showing a decline in inflation expectations and compared to this? And that's because we know tariffs are inflationary, but that's not a permanent hit. It's a one-time hit. Companies will raise their price and then they're done, right? Which means that you'll see inflation rise, but it's not a permanent reset, unlike years past where there was so much money floating around that people didn't know what to buy. So they bought everything. Everyone went on Amazon and went buy, buy, buy. And that sends inflation across a wide variety of baskets rising. And this is one of the reasons why we think that, yes, inflation is going to be higher and stickier for longer, but a very different expectation than, let's say, coming out of COVID, where supply chains were permanently disrupted and it took a long time to adjust as we had increased in money supply. What does that mean to conclude this from an interest rate perspective? Markets are expecting the Fed to start cutting interest rates. We've seen quite a bit of variation, but it went from 0 interest rate cuts in the first half to possibly 1 interest rate cut coming in May, with some additional interest rate coming through in the second half. Why? Because the Fed will have to manage growth slowing and inflation going up. But if inflation is a temporary one-time hit, it needs to worry about the growth side of the equation. So that's where we see, yes, tariffs are going to push inflation up, but it's much more of a, I hate using the word transitory because that's sort of that ugly word that got, everyone got quite upset at it, but it has a slightly different effect than, let's say, in the past when we had too much money chasing too few goods, sending a permanently higher reset on inflation. So higher inflation, but not like 2020, and interest rate cuts because of the growth impact.
You mentioned slowing growth, and so it's a good time to come back, I think, to your comment of 50-50 as far as a recession. Can you add a few comments around that, just to say what would either increase, that to be more probable or decrease it to be less probable?
So a very simple answer is if tariffs go away, either delay, or disappear. I'm calling it the delay, disappear, right? Act. And or we come to the table with deals as this 90-day period pause comes through. You've seen the European Union wanting to do reciprocal tariffs and then pulled back. So either a delay, a deal in some form on tariffs and removing this cloud of uncertainty, and you'll see the probability, which allows companies. I think the biggest thing is companies don't know what to do. It is hard in the midst of a slowing economy to say, let me bring back manufacturing and take a permanent hit on my earnings, knowing that costs in the US are much higher than wherever they are currently. The companies aren't going to do that, especially for low margin goods. A t-shirt maker is not bringing back that to the US and taking that $5 t-shirt as an example and making it a $50 t-shirt. It's just not going to happen. And so I think that's the key piece. Any relief on tariffs is going to improve or reduce the probability of a recession. On the contra side, if we see additional sectoral tariffs, what has not been put in place has been things like pharma companies being targeted. For quite a bit of the baseline part of the pharmaceutical goods are built abroad and then bought back into the US. If more things come under the tariff banner, then the probability moves from 50-50 to a little higher. That's where we're watching for. I think that is almost sort of a zero-sum game in moving this this probability.
Great. Well, we've come to the end of our questions, and I know that a lot of it was sort of revisiting comments that you made and presented during your slides, but it's helpful because we're going through it so quickly and moving through to kind of circle back and touch on some of those points. So with that, I think it would be good to revisit the comments that you made about this whole idea of staying invested. I think as investors, it sort of, gets a bit of an eye roll sometimes when they're calling and saying, I feel like I need to move out of the market. I feel like maybe I should, take some risk off the table. And as advisors, we're always coming back to that idea of, long-term investing and the wonderful slide that you show as far as how the declines and positive points in the market kind of are closely tied. So just for anyone on the call who's really starting to say, I'm feeling nervous. I'm feeling, this is maybe a little bit of a calm in the middle of the storm. What comments would you leave with them as we close out the conversation today?
I'm going to say two things. One, we've seen quite a bit of the pullback in markets already. So you've seen the year to date, we got all the way down to 19% from the peak on the S&P 500 to the drop. So we've seen companies' valuations, which is where we were concerned. They were quite high in the US. We have seen that retreat. So that gives us some consolation in that we're not reaching, asset bubble territory anymore. So that's actually a good thing. Without corrections, we would have asset bubbles. No one likes the outcome of how it comes about, but it helps reset markets and reset companies to kind of be priced more towards normal levels so that we have a more sustainable growth trend. And the second piece I'll say is, remember why we invest. As investors, I call ourselves as permanent rubberneckers. We're driving on the lane of investing, and we're constantly looking to see what's going to derail or cause our portfolios to go out of bounds or crash. But remember why we invest. And what is that? Innovation does not stop because of the current policies. Now, they may be delayed, but that does not stop. I think about the medical innovations that are taking place as a result of, AI likely speeding up those research. And that type of growth is why we are an equity investor. We balance that equity innovation interest and also risk premium out with the bonds, which now provide reasonable yields. And I think in the midst of uncertainty, balance is likely the boring, and diversification is also a very boring principle, is why we rely on those. This is not when we lean one way or the other, because it's very hard, as you stated. What sectors are going to win? It's very hard to do that. And this is where we come back to the let's ensure that our portfolios are adequately balanced as well as diversified, so we're not exposed to any singular region, any singular stock, any singular sector, without forgetting that innovation has not stopped, even amidst what seems to be a chaotic time for companies. And what we cannot see, I'll use this example. 3 years ago, nobody was talking about AI and ChatGPT. Now it seems to be the norm. That's why we invest. We invest for the innovation we don't even know is happening today. That's why you give companies that are quality to adapt to coming through times like this. And I think that's sometimes we just don't get a moment to discuss that. So I'm glad you asked me this question. As an equity investor, we're looking for those types of opportunities in the midst of companies that will come through this. And one day we'll get a chance to hopefully talk about those things outside of the tariff spectrum as well.
Well, thank you so much, Kezia, for your time and your comments. I also want to thank everyone that joined us today. If you have questions about your specific portfolio or investments, circumstances, I encourage you to reach out and schedule a time for us to connect and really talk about what's happening in your world because as Kezia mentioned a couple of times, we feel like a lot of things are happening. And so the question is, how is that impacting our portfolio, not just what we broadly hear from the overall market? So look forward to hearing more from Kezia in the future. We have lots of resources that are available. So as times change, we'll be sure to make sure you stay current. And Kezia, we won't hold you to the comments you make in the morning being true at the end of the day.
Thank you for that. And I hope everyone gets out and it's springtime. There's flowers here in Denver, Colorado, and I'm going back to remembering what brings us joy. And also my 13-year-old niece who apparently still likes to draw and still has no idea what tariffs are. And I'm going to lean in on her.
Great. Yes. Everyone go out and enjoy the beautiful sunshine that's here in the Pacific Northwest as well.
Take care.
Thank you. Bye.